Hey, it's Tyrone Jackson coming at you again with another Wealthy Investor video from the wealthyinvestor.net. Today I'm going to talk to you about stock market trading, generating monthly residual income, and something that a lot of traders overlook, which is risk. You see, a lot of people like to talk about actually owning stocks, but what they don't assess is how much risk is involved in that stock. The goal in stock ownership is to own stocks that have a tendency to go higher. So I want to talk to you about two stocks. Now, one that's in the Dow Jones Industrial Average, that's DuPont, and another stock that is not within the Dow Jones Industrial Average. This is a company called Discover. You know their product, their primary product, because it's called the Discover card, but they actually make their money lending out to businesses and student loans and a lot of other things. But the Discover card is what they're best known for. Now, when we look at these two charts, we notice that they're both rising. You know, in the Wealthy Investor program, I always teach you that you want to go on dates with stocks where the chart is actually rising. Let's take a look at the 52-week range, $46.93. It's been as high as $64.44. This company, it's rising because the company is making revenue off of all that interest, billions and billions of dollars. Let's go back to this Dow component, which is DuPont, which is more of a steady eddy. It's been around much longer. You'll see here the stock ticker symbol is DD. The stock has risen. A lot of institutional money here. Take a look at the 52-week range here. And you'll notice that it's been as low as $56.09, as high as $69.75. Pulled back a little bit off its 52-week high because of some conditions that's going on in the market. But see, this stock, although you can say, well, Discover can go further, this stock has less risk in it. And this is where when you want to start to handle your own money in the stock market, you really need a financial education. The amateur says, hey, Tyrone, let's just look at which stock has gone the fastest in the last 52 weeks because I want my stocks to appreciate quickly. But if that's the approach that you take and you have no sense of risk, guess what? That stock that's gone the fastest, unlike DuPont, could have a very quick reversal if the company makes less money, okay, on a quarterly basis. So it's not just about trading and stock ownership, it's about risk. So remember, we have this Dow component, DuPont, and then we have a non-Dow component, ticker symbol DFS, which is Discover. Now, what I teach in the Wealthy Investor program is I can take these stocks, and my students make thousands of dollars a month doing this, rather than just owning the shares. As soon as we buy the shares in these particular companies, we're going to generate instant residual income. And how do we do that? By selling an option to someone we don't know to buy the stock away from us. All right, let's talk a little bit here about covered call writing, because there's some controversy that surrounds it for some people, but it's really simple. Do you want to own a stock and no matter where it goes, make sure you make guaranteed income? Well, if that's the case, then you want to be a covered call writer. Remember this. Remember, it was me who told you this. For the non-professional trader, someone who's trading either at home or on their own because they love it, the best trade that you can learn in the world is covered call writing because it makes money for you 100% guaranteed every single month. Let's look at this Dow component, ticker symbol DD. Now, I like the fact that this stock is not going anywhere because I'm going to make a lot of money off of just selling covered calls. We're in the month of August. This is the September call option chain. If the stock is trading at $64.03, I'm going to sell the right, not the obligation, to someone I don't know to buy the shares away from me at what? $64.50. Let's go back. If the shares are at $64.03, I'm going to sell the right to someone I don't know to buy the shares away from me at $64.50. You notice I'll be selling the stock for a profit, but what am I going to earn? I'm going to earn 89 cents a share, because in the stock market, when you sell something, you sell at the bid price. When you buy something, you buy at the ask price. I'm going to earn a guaranteed 89 cents a share for selling the right to someone I don't know to buy the stock away from me. Now, how could you beat that? Because if you had 100 shares, this transaction must be done in 100 share increments. So if I put up $6,400 and I know I'm instantly, 3 seconds after taking possession in the stock in my online brokerage account, I know I'm going to make 89 cents a share or $89 guaranteed. What does this mean? It means if I use my money and I buy 1,000 shares, I earn an instant what? $890. Now let's stop here for a moment. Because when you have a financial education and you have a chance to make $890 3 seconds after taking possession of a stock, is that good money? Let me talk to you about this 89 cents a shares, and I am going to use the illustration of 1,000 shares just so you get the point. If I am earning 89 cents a share times 1,000 shares, that's $890. When does this money show up in my brokerage account? The answer is simple. In T plus 1. Trading day plus 1. I bought the stock on Monday. I have $890 that I could use to either spend, pull right out of my brokerage account, or what? What do I teach you in the Wealthy Investor Program all the time? We're going to reinvest the money that the market gives us. If the stock never reaches $64.50, do we get to keep the 89 cents a share? Of course we do. In a low risk stock, yes. Now, whenever I'm teaching this at my in-person seminars, people say, Tyrone, this sounds too good to be true. That's because all wealth is taught. And if you do not have a financial education, you miss out on all this money. This 89 cents looks like a small amount of money, but it's per share, per contract. It comes out to $89, and if I have 10 contracts, I make $890. Why in the world do I need a high-risk stock when I have a Dow component like DuPont just giving me money every single month? Remember, what is my risk here? It's low. Why? Because I'm in a Dow component. And really, if you want to play the game at the higher level, not only am I a Dow component, I'm in a Dow component that pays a what? A dividend of $1.80 per share. So not only am I going to get paid the covered call money, I'm going to make this dividend every 13 weeks. It's actually divided by 4. I'm going to make this every 13 weeks guaranteed. You see, if you're just starting out in the stock market, you don't want to just make money. You want guaranteed monthly residual money. That's how you become a wealthy investor. So when I show people how to make $1,000, $5,000, $10,000 a month, and some people say, oh, that's not realistic. What are we doing? We're selling call options on stocks that we own, and we're collecting what? Dividends. Now let's look at a stock that is not in the Dow Jones Industrial Average. So the only thing is, when you don't have a financial education, the only thing you can rely on is stocks going higher. And what am I teaching you here today? How to take guaranteed residual income. Here we are back at Discover. Now we look at the stock. Again, 52-week range has been as low as $46.93, as high as $64.44. Great looking chart, right? Why did I buy the stock? To sell it. Just to sit there and talk about how cheaply I bought it? No. To generate income as a covered call writer. When you have your money in a mutual fund, mutual funds do not make money for you every single month, but covered call writing does. The stock is at $59.59. What am I going to do? I'm going to September, a month away. I'm going to sell the 60 strike call, right, for $1.35. Now let's stop. I need at least 100 shares to sell this covered call, right? And I'm going to take in $1.35 per share. But if I have 1,000 shares, that's $1,350. $1,350. You see, if you don't have a financial education, you are locked out of the game. Stocks are not just about which one goes higher and the fastest. It's about risk. Now, since I am in a higher risk stock, a non-Dow component, this is what's known as an out-of-the-money call. I'll give you another lesson. I would lower my risk if I sold the in-the-money call. For those of you who really understand that, if the stock is at $59.59 and I sold the $59.50, you notice here if the stock dropped below $59.50, I'd actually be making more money if it drops. I can even sell the 59 strike. I'd make more money on a drop of the stock. This is called a hedge. You see, a financial education is powerful. It is not just about buying stocks and hoping that they rise. When in this day and age, we can make guaranteed monthly residual. Look at all this money in the bid column. We can make guaranteed monthly residual income or weekly residual income selling options to other people. So I want stocks to move slower because it gives me more opportunity to make guaranteed money. Now, if you didn't know that before, you now know something different. And your goal is to not just to be a trader, not just to be an investor, but to be an educated, wealthy investor.